once again, Ohio. This is the Retirement Blueprint Show with Tim Lofton of Axum Planning and Wealth. I'm your host, Spike Spangle, and every single week we try to help you with retirement planning solutions. Mr. Tim Lofton, what's on your mind this week, my friend?
I want to talk about interest rates, Spike.
Interest rates. Interesting.
What to do.
What to do.
What not to do.
All right.
And how long do we have to do it?
Well, that's very important because, right? According to our Fed Chair, Jerome Powell, we're looking at interest rates possibly moving downwards 4, 5, maybe 6 times this year alone. Over the last 18 months, we saw interest rates move up many times over the last several months, of course affecting your mortgages, of course affecting your credit cards, and the entire bond market across the United States. So you're going to pull out your crystal ball and tell us what's going to happen this year?
I am going to pull out my crystal ball and tell you what other people's crystal ball are saying.
All right. So when interest rates go up, it affects our bond values in different ways. It affects the choices we make. We saw the calamity that it created in our economy the last couple of years. Let's go beyond even me and you. Okay? Let's take ourselves out of the equation.
Okay.
Let's use somebody like Morningstar. What are they saying?
Well, interestingly enough, Morningstar is predicting up to 6 interest rate cuts in 2024. And the impact of that, when you understand what interest rates do to the markets, to things like bonds, we understand a lot of times when we're looking at lower interest rates, what do? We want to refinance our house, refinance our credit card, refinance our car. But when interest rates are still high, there's an opportunity for us to take advantage of that.
Yeah. So, when our interest rates are going down, of course, we want to take advantage of that. And so if you had a 5% mortgage and you were able to get it down to 3.5%, that means you got more money in your pocket to spend every single month. So with Morningstar, just using their math on this and what the Fed chair may or may not do, 5 or 6 interest rate changes. Now, these usually aren't at a percentage point at a time. They're small increments, right? Yeah,
they're typically a 0.25% here, 0.25% there.
Okay, all right. And so if we're at around 5.5 right now?
Yeah, 5.25 to 5.5. That would take us down, somewhere in that 3 3/4 range on rates. Now that doesn't seem like a lot. Going from 5.5 to 3.75, but that is a major move when we start talking about how bonds are impacted, and understanding too, a lot of people have been locking in those higher rates on things like certificates of deposit and money markets. Understand that those rates will change very quickly as the rates come down. And so the question is now a good time to start thinking about maybe we should be locking these rates in for a longer period of time if we know that there's a chance they could go down.
Right, because we call it the safe money right now. I mean, you can go to probably one of your local banks or certainly those online banks, and you're seeing very good numbers out there.
Right.
But they might not last. Now, not that they're going to go back down to where they were pre-COVID and 2020 before that, where interest rates were essentially zero. In fact, there were some interest rate bonds in Europe that were a negative.
Yeah.
You would give them money and you would get less back. I didn't understand that at all.
I don't know how that worked exactly, but I would like to be on the receiving end of that. So I'm going to loan you $50,000 and then you're going to pay me back 51. Right? I mean, it's like, what is that? Yeah. What does that even mean?
But for our consumer, and most specifically, as we talk about the retirement blueprint, for our retirees, what does that mean for them? Because if we've moved a large amount of our savings over into these 4 or 5 or even the 6% online accounts, do you think those are going to stay over the next year?
Well, I mean, if you look at where interest rates are heading, the answer is probably not. I'm more interested in making sure that why did I put that money in there to begin with? What is the purpose of the money? If it's for income and I'm actually using that income as part of my retirement plan, I need to take a careful look at this, because when interest rates go down, that means my income is going to go down. That's really the idea behind refinancing your retirement. If I can lock in these rates that are still where they are today, they're at a great rate relative to where we've been for the last 10 or 15 years. and I can lock that in for a longer period of time. That's going to give me more knowns with my retirement income. I'm locking in for a longer period of time. I know what's going to be coming in. Whereas if I have a 3-month CD, a 6-month CD, that may be locked in at 5%. It could renew at 3%. Well, I mean, 2% is a big difference. I mean, if just think about it from on $100,000, you're talking about a $2,000 drop in return.
Right, and plus, don't forget, and I think this is where a lot of the shortcoming comes up for some folks doing this, what we call in behavioral finance mental math. Like, oh, I'm getting 5%. Well, you're not getting 5% if it was a 9-month CD, because that's the annual percentage rate. Plus, there's the taxes on it. So is it worth it? I mean, we're looking at a 5.25% for a 9-month CD. Are you actually keeping all of that after taxes?
No. So if I'm getting 5% on a 9-month CD, understand the math behind that. So first of all, I have to look at it after tax. What is my net number in my pocket? And then I'm only getting that 5% for 9 months, not 12 months. So all of a sudden that rate starts to really be diminished as I'm looking at my overall return.
Right, right. And now, I also want to talk, when we come back after this message break here, a little bit about the kinds of other products. So there's the safe money right now. There's also things that are inside, let's just call it annuities, because that's what they are. Are those rates going to stick around as well? Before I get to those, though, the retirement blueprint. We've got a little bit of a brand new logo back here. If anybody has seen any of our other 80 television programs that Mr. Tim Lofton has done. But the retirement blueprint, has that changed as well?
No, the retirement blueprint is still the same. It got a facelift, but what it is still the same thing. That's where, we're going to develop an income plan, a tax plan, strategy around estate planning, investment planning, and making sure that long-term care and healthcare are all buttoned up.
All right, and then now we've discussed this as well before. The retirement blueprint. This isn't necessarily just a deliverable where you call into the program right now and you send out the blueprint. Maybe you can explain a little bit more about the process.
Yeah, so the retirement blueprint is something that is custom made. It is a written retirement plan that we design for you. It is taking in everything that your family wants to have happen, how you want things to pass on. It's looking at the tax microscope to make sure you keep as much of what you make as possible. But it is something that you have to come into the office and sit down with us to get.
All right, Tim, we're going to take a very short message break here. Folks, don't go anywhere. You can get your own retirement blueprint from Tim Lofton right here of Axum Planning and Wealth just by calling the phone number you see down here on the bottom of the screen. Folks, there are literally people standing by right now. It goes over to our secure call center and we'll set up that appointment for you. You can also open up your phone to the camera function and point it at the black and white box, that QR code. If you want to, if you prefer to do that right now, because when you click on that, it'll take you over to the website, scroll down about ½ an inch, and you can click on Claim My Appointment. More with Tim Lofton of Axum Planning and Wealth and the Retirement Blueprint Show when we get back right after this.
Better is just better. Wouldn't you agree? It's the American way, from a better house to better careers to a better education for our kids. Americans strive for better. So when it comes to your retirement and retirement planning, what could better mean to you? Better income? Better lifestyle? Better solutions? Find out what a better retirement could be like for you. Call this number for your own complimentary portfolio review and written financial plan, or scan the QR code below. It's your retirement and your opportunity for better. Have you considered refinancing your retirement? When interest rates are low, you might be able to refinance your homes, your car loans, and even your credit card rates, because it could help you keep more of your own money each month. But what happens when interest rates go up? It may make sense to refinance your retirement. Higher interest rates could provide income opportunities that you may not be aware of. What works for your portfolio during low interest rates may not work for you in a high interest rate environment. So don't look down at today's higher interest rates. Instead, find out if a retirement refi could work better for you. Call the number you see here or scan the QR code below to schedule your complimentary Refi Your Retirement review today.
Welcome back to the Retirement Blueprint Show with Tim Lofton of Axum Planning and Wealth. Today we're talking a little bit about where interest rates may or may not go over the next year, but more importantly, what that means for you, our retirees. With these rates looming, we go back to the 60-40 portfolio.
Right.
We know what happened 2 years ago when interest rates started going up. The 60-40, and you can check our math out on here, go to the interweb where all of the facts are true. But the 60-40 had the worst performance year in over 4 decades.
Yes.
So if interest rates, again now, if they go back down, what do you think is going to happen to our middle-of-the-road portfolio?
Well, it's very possible that we will see the inverse of what we saw a couple of years ago. So during that time period, the 60-40 portfolio was down about 17%. And not saying or predicting what the 60-40 might do in the reverse of that, but we are in a period of time where, the market has been pretty good. We get a cut in interest rates, which makes bond values go up. If both of those things happen, we could actually see, kind of a rebound from that down year.
All right, so kind of maybe a reverse then, I guess, of what happened there. So right now, though, if these are some of the better interest rates that we've seen in a long time, do we want to hold on to what we have? What do we do? What do we do with the bonds themselves? What do we do with the safe money? What are our action steps right now? Or do we do nothing? Do we leave everything alone?
All of those are an option, Spike. When you look at those, because those are all different strategies, right? I mean, my cash is cash, and typically when we're looking at our client's scenario of what we call emergency money, this is money that you keep that's readily accessible, that if you needed it, you can get it. We want to make sure that we don't have too much there. But we also want to make sure that we're not underfunded. In other words, if somebody only has $1,000 and they need new tires or their HVAC system goes out, we don't want to be moving to credit cards. But the flip side is true. If we have kind of put a larger amount of our cash on the sidelines because rates are so good, maybe now is the time to look at locking in those rates for a longer period of time. That may be done through CDs, it may be done through bonds, it could be done with annuities, but looking out at the rates the way they sit and understanding if the Fed is going to cut interest rates, and that's what everyone is predicting they're going to do, we should be taking advantage of that. I mean, on the bond side alone, if you think about locking in a 5 or 6% rate on a longer term bond, and I'm talking more 5-year, 10-year,
Okay.
then interest rates go down. Not only am I getting that 5 or 6% that I locked in, I'm also getting the appreciation of the bond value, which is not typically why we buy bonds. We usually buy bonds for income, not capital appreciation. Yet it could be a byproduct of those interest rate cuts.
Right, and you're not necessarily saying this as speculation of what you're saying, but this is just how bonds work.
Right.
When interest rates go down, bond values go up.
Listen, it took 11 Fed hikes to get us here, right? And so as they back this down to a more reasonable number, something that fits more along the lines of economic philosophy, if you look at it from a long period of time, it very much could be, listen, if my worst case scenario is I'm getting 5 or 6% on my safe money and bond values don't go down, I'm still getting 5 or 6% on my money. If they do go down, I'm going to make more.
Right.
So,
and maybe that's something we need to also kind of explain to the viewers. When we're saying your bond value goes down, we're saying that in a relative sense, if you're trading bonds, if you hold on to the bond, I mean, even if it was only 3%, you held on to it for 10 years, you're still going to get all of that back as long as that company is insolvent, or as long as the government pays it back. But so we're not talking about actual loss. This is when we start talking about paper loss and real loss.
Right.
If you hold on to your bond and it only makes 4% over time, you still get that 4%, and then you get that bond value back.
And you made a good point there, Spike. Unless the company that the bond was issued by is insolvent. One of the mistakes that we are seeing more of today is people come into the office and they'll say, well, I saw that this bond was paying 8 or 9%, or that this preferred stock was paying 8 or 9 or 10%. rates way above kind of where everything else is, you have to understand that there's going to be a higher underlying risk. So if the reason why you own that is for safety and for income, I need to make sure I'm not taking too much risk in that area when I could maybe take more risk on the stock side without having the bond risk associated.
I'm so glad you brought this up. So now it's your own fault for doing so. So you said some of these rates, we're seeing at 8% or a 9% or a 10% or a 15%. What about these ones out there? Because I'm seeing them in some of these tools, again, called annuities. What about this bonus? Who's
Right.
giving me a 15% bonus? What is this bonus? Is the bonus real, or should I be cautious about this?
Well, you know, one of the problems that we see with annuities, and we have clients that will bring in, you know, they may be meeting with not just us, but maybe a couple of other folks. And, you know, we always are interested to see what other advisors, other companies are offering to the people that we're meeting with. And they'll come in and they'll say, hey, you know, we were told we could get this, we could told we could get that. A lot of times those are shiny objects. They're not real in the way that you and I think real. When you say I'm going to get a bonus, I'm thinking I'm going to get a cash bonus, like that money is available to me at some point. Not all annuities work that way. Sometimes that bonus is to the income bucket. It's not actually money that you could physically withdraw. It's going into a number that they're going to then allow you to take income from over time, which is going to make you married to that product most of the time. When we're looking at a bonus, and this is where the refinance or retirement has kind of come from, is sometimes people have a really low interest rate, 1%, 2%. That's the most that they can make. And not a lot, but there are some companies out there that we work with where you're actually getting a cash bonus, because a lot of times they would have to pay a surrender penalty, you know, 3, 4, 5% to make that change. That bonus is helping cover that, plus maybe a little bit of extra. It all comes down to the plan and having somebody sit down with you and evaluate, you know, here's where you are, here's the most you could possibly make, here's what it would cost to make a change, and here's what you would end up with. It has to be done with somebody who knows what they're looking at, because a lot of times people come in hearing, you know, I'm going to get a bonus or I'm going to get this, but when you actually sit down and look at the numbers, it doesn't add up the way they think it's going to.
Okay, and that's exactly why we want to review this stuff before we make any decisions. One of the harder things that we hear, either during the radio program, which we've got on WHIO, or when people call in from this show, or when they come to see you in the offices, I made this decision. What do you think about it?
Right.
And so, wait a second. Before you make the decision, do yourself a favor. Call the phone number you see down on the bottom of the screen. That's why we're talking about the refinancing your retirement. We're going to explain a little bit more about that when we get back from this very short message break here. But you can do a review on should you refinance your retirement. We'll explain more what that means. But folks, as one of the viewers of our program, you can call the phone number, set up an appointment, come in, sit down with Tim Lofton. There is no cost to that. There is no obligation. Call the phone number you see down here. More of the Retirement Blueprint Show with Tim Lofton right after this.
My most rewarding moment for helping clients is seeing the fear of the unknown disappear from their face. You know, some people are worried about a potential nursing home stay. Some, it's market volatility and losing their money in their investment. Some are just genuinely concerned about the direction of the economy. But for the most part, the whole taking away of fear and concern starts with having a plan. Not something off the shelf, but something customized to that family, where we can sit down and get to know them intimately, to understand what their hopes and dreams are. What do they want to have happen after they're gone? And make sure that those things happen. The Retirement Blueprint is exactly that. It's a blueprint for retirement. It's built off of the 5 cornerstones of retirement planning. That's developing an income plan, creating a tax plan, an estate plan, a long-term care and health care plan, and of course, the investment plan. And the best part is we have a team of people to come alongside to do all of those things, that have the credentials and the expertise and the years of experience to make sure that everyone is coming together to create the best plan. It takes those worries out of their head and put solutions down on paper.
Welcome back to the Retirement Blueprint Show with Tim Lofton of Axum Planning and Wealth. I'm your host, Spike Spangle, and today we're talking about some things to set you up for success for the rest of this year. We've been mainlining about interest rates and what's going on there, but let's maybe broaden the scope a little bit. We can't control what the Fed is going to do.
Right.
We can control what kind of portfolio we have. What are some other things that we can do to set ourselves up for success?
Well, certainly, risk is something that we have control over. And I think, when we think about risk, it means different things to different people. If I get really frustrated with the idea, there's firms that'll say on a scale from 1 to 10, what number are you? And somebody says, well, I'm a 6. Well, Spike, the 6 to you and the 6 to me and the 6 to them all means something different. And so,
Here, I'll pose it to our viewers like
Okay.
this. On a scale of 1 to 10, how well are you getting along with your spouse?
Right.
Well, first of all, I'm not answering that question.
answering that question.
I'm not answering that question on air. But second, what does the number mean? I mean,
It doesn't mean anything.
When it relates to your investments, did you put a dollar amount on risk? How do you explain it?
Well, we use a program called Riskalyze. It actually won the Nobel Prize for economics. And what I love about the program is that it gives people something that they can relate to. It says your portfolio, the way it sits right now today, in 2008 went down this, in 2013 when things were good, it went up that. And I can look at it in black and white in dollar figures, not percentages, because our clients don't look at ups and downs in percentages. They look at it a dollar amount. I have $1 million invested, it went to 800. That felt bad. I have $1 million invested, it went to 1.2 million. That feels good. It's Pavlovian.
Yeah,
right?
There's Pavlovian, but the other behavioral part of it is that more people pay attention to the loss than they do the
They
gain.
absolutely
They're
do.
more affected by the negative side of it. So we've got to be realistic.
10 to 1.
If you lost $100,000 off a $1 million account, how would that make you feel? But more importantly, I've actually heard you say this. How would it affect your retirement? So if you're in retirement, you're drawing from that account, you lose $100,000, would it affect your lifestyle? And how do you secure the lifestyle from being affected?
And I think that's two different conversations. We have to think about those right now that are saving for retirement. They're in that accumulation mode. And honestly, volatility isn't a bad thing. It actually can be your friend. I mean, think back to 2008, 2009. The market was down significantly. But remember what you were doing every 2 weeks when you put money into that 401k plan. You were buying it on sale. Volatility was working in your favor. When I cross over that threshold to retirement, it's a different scenario. I'm no longer putting money in, I'm taking money out. And so when volatility hits, it can absolutely impact my ability to live my lifestyle the way that I want. So it has to come back to what stage are you in, and then evaluating that risk. But there's other things you can do if you're in that saving that you do have control over.
All right, well, how about those old 401ks? Again, we don't know what the markets are going to do. We're talking a little bit about the markets, but more importantly, interest rates. And we do know that those will probably go down this year. And if they do, that does affect the markets because people are watching what's going on and they're affected emotionally.
For sure.
If we've got old 401ks that are sitting around somewhere, what should we do with those?
Well, a lot of our clients come into the office, and I'm always amazed that they may have had 5 or 6 different jobs, and they had a 401k at each job, and they just kind of left it there. And you know what? I would rather them leave it there and let it grow than to micromanage it. But as we're getting closer to retirement, now's the time to start circling the wagons a little bit, right? Let's get all that stuff in one spot. Let's determine what that money is supposed to do. Let's start giving jobs to the money. If it's for income and I'm still in a 401k, I can't get a guarantee that really gives me much on the way of interest rates, and it's really not going to help me generate income. That's a different job, typically outside of a 401k, because the 401k's job is to grow money, not to help people retire and produce income.
Okay. So we definitely want to move those along. And then if we're rolling over a 401k or an old 401k, can I turn this into a Roth? Should I turn this into a Roth? do we pay that tax, or is it too late? If it's already been a tax-deferred account, is it always going to be a tax-deferred account?
Well, it's never too late, and it really comes down to, again, kind of where you are in the cycle of life. You know, if I'm already retired and my income is low, it may make a lot of sense to evaluate whether or not tax strategy like a Roth conversion would make sense for down the road. It would reduce your required minimum distribution. That's the money the government makes you take out. It could potentially reduce your taxes when you pass that money on. So there's a lot of potential advantages. The problem is that, you know, people will listen to the show and they'll say, oh, you know, I should do a Roth conversion. No, that's not what we're saying here. What we're saying is you should have information on whether that or not that makes sense to you. That starts with sitting down with us, letting us look at your tax strategy, determining if there is a better way of doing it. It may be a Roth conversion, it may not. It really just depends on the individual.
Tim, for our folks here in Ohio, why in the world would you do all of this work, do the retirement blueprint, do this at no cost? I mean, come on, you work for a living. I know you didn't get that suit at Sears.
I did
no
not.
offense to Sears, but I don't think they sell
And I
suits
have three
anymore.
teenagers.
Right,
so
you got three teenagers.
There's a little bit of cost
You've got
there.
a practice, you've got a family. Why do you do the retirement blueprint at no cost?
Well, it's pretty simple. Our philosophy is we want people to work with us that want to work with us. And if we charge somebody to just get to know us, that stands in the way of them maybe giving us a shot.
I've even heard this I've gone in to go take my car in before, and they say, all right, we'll run the evaluation. We just want to let you know before we actually do any work. It's $100 to run the evaluation.
Right.
I'm like, well, what? Before you even do anything to it?
Well, I mean, listen, what if somebody came in and gave us money to meet with us for us to turn around and say, you know what, you're good just the way you are. You know, do I get my $100 back?
Yeah. Yeah. So the retirement blueprint, no cost to our viewers. Real quick, only about 30 seconds here. What does that cover?
It's going to develop an income plan, investment plan, tax plan, estate plan, as well as looking at healthcare and long-term care savings plan. Basically, it's everything that you need to be able to retire and stay retired.
Thank you so much, Tim Lofton. Thank you so much, our viewers, for watching the program. Now get something out of this yourself. Call the phone number you see down here on the bottom of the screen so you can get your own retirement blueprint. There is no cost, no obligation to you. We do this for the folks in Ohio, so take advantage of it. You can also use the QR code. Open up the phone to the camera function. Click on that black and white box that you see down there on the bottom of the screen. Go over there. You can claim your own spot. Thank you so much for watching. We'll be back next week.